Hi, and welcome to Homework Rant by Professor Elizabeth Keating. In these various videos, I'm going to be walking through how to solve selected problems from the Introduction to Financial Accounting textbook by Horngren, Sundam, Elliott, and Philbrick. And I'll be drawing from edition number 11, which is also the same as the second custom edition being used at Boston University. In this video, we'll be looking at homework problem 137. The goals and objectives for this particular one is first to determine if certain activities generate journal entries. We'll be using the financial statement template and get a better sense of how to use it. We'll be introducing some important accounting concepts. We'll be looking at the concepts that are important to know in determining whether or not to record a transaction. We'll also be looking at the idea of the economic entity principle. The problem starts by saying that you're going to be starting a new business and you'll be a wholesaler of auto parts in Lisbon, Portugal. As you're just starting a new business, you have no assets, liabilities, or equity, and therefore when we set up the balance sheet equation as the starting point, we'll have 0 equals 0. In other words, nothing equals nothing, and everything is in balance. Now, using the financial statement template, we'll be entering our first transaction. On March 1st, 20x1, you invest 80,000 euros cash in your new sole proprietorship, which you call Auto Parts Lisbon. What you can see displayed here are now we've selected what the first two columns will be headed. The first one, the heading is cash. You'll see it's located on the left, meaning it's an asset, and you'll see on the right, paid-in capital, which is an equity account. So you'll see under cash now, a row appears labeled journal entry number 1, and the amount of 80,000 euros is sitting in the cash column in black, meaning it's a positive number and an increase. You'll see incomparable 80,000 euros in black on the right-hand side under paid-in capital. So this journal entry is in balance with 80 equaling 80. Now onto activity number 2. You acquired 10,000 euros of inventory for cash. This is a kind of asset swap. You are purchasing an amount of inventory using cash. When you engage in a purchase such as this, there is no gain or loss on a purchase. So what you can see denoted in the financial statement template is that there's now a third column, inventory. It is sitting next to cash on the left-hand side, denoting it's an asset. And you can see a red arrow and a red number in brackets in the cash column on the row associated with activity number 2. And the red and the brackets both denote a decrease. In the inventory column, you'll see a black positive number denoting an increase. So when we go to look at what's being added to the books, you'll see on one side of the equation, the asset side of the equation, we have a decrease of $10,000 offset by an increase of $10,000. And in that way, we're keeping the balance sheet equation in balance. So here we are at activity number 3. You've acquired 8,000 euros in inventory on open account. Another way of saying that is you've purchased inventory either on account or on credit. Any one of these terms indicates that you received inventory today and you're paying for it later. So this is the first transaction that we are recording where there is not a cash movement involved. So one can justify that there needs to be a journal entry in the first two instances because we have to reflect the cash movements on our books. In this case, we are reflecting a journal entry because we're taking on a new asset. We have a change in the economic value of the firm, so we need to reflect that change in economic value even though that change is not signified by a cash movement. So when we have this kind of situation where we have a change in economic value but no cash movement, we're engaging in an accrual accounting transaction. And almost always when that occurs, we have to take into consideration the fact that there's a timing difference. that the economic change in value happened at one point in time and the cash movement is happening at another point in time. To accommodate this timing difference, we end up creating some special accounts, and one of them is an accounts payable. What accounts payable means is at some point in the future, we will be paying an amount we owe to somebody. And this kind of entry that we're doing right now, where we're creating an account payable, is called an originating entry. And later in this example, we'll see instances of reversing entries. In activity number 4, we're going to be purchasing some equipment. The equipment is valued at 15,000 euros, and we're going to pay for the equipment with 5,000 in cash and 10,000 in the form of a note payable. You can see this is a complex transaction. So there's receiving one thing, equipment, but paying for it with two different methods. When we have a complex transaction, the journal entry has more than two elements to it. If we look at how it is that the balance sheet equation is staying in balance, it's a little more difficult to ascertain. On the asset side, we've taken on a piece of equipment for $15,000. Also, on the asset side, we have a decline of $5,000 when cash is paid out. So we have a $10,000 net increase in assets, which is offset by a €10,000 increase in the form of a liability, a note payable. A frequent question that arises is what's the difference between the accounts payable that we saw in activity number 3 and the notes payable that's being used in activity number 4. In the case of an account payable, that word account comes from being on account, that you're providing credit to someone, often for a normal business purpose, and the underlying transaction is a normal business transaction that will be paid for quickly in a short-term period, and there's not a particular focus on there being some sort of interest associated with that business transaction. A note payable, on the other hand, means that the transaction is being denoted by a form of a note, such as a promissory note, which is a signed commitment to pay off an obligation, and that signed commitment inevitably includes some kind of interest component. So it's an interest-bearing note. And often the person being willing to provide the financing might be some form of lending institution. A third important thing to note in activity number 4 is the fact that equipment is being purchased. I want to spend a minute talking about the difference between equipment and inventory, which was previously purchased. When we purchase inventory, we're purchasing goods and materials. The goal of what we have purchased is to resell those goods and materials, presumably at a profit. In contrast, when we're buying equipment, which is a form of a fixed asset, or actually whenever we buy a fixed asset, we are buying property, plant, and equipment. These are tangible assets that have a long life, and the goal is not resale. The goal is to produce inventory or services, and it is the inventory and the services from which the firm will profit. In activity number 5, we found out that we have lost the possibility of doing business with a good prospective customer because that customer has decided to discontinue operations. We don't have any ongoing business or current business with this prospective customer. This announcement involves no cash movement, and there's no direct or measurable impact on our current business transactions. So there's no immediate impact on the economic value of our firm that we can measure or assess. Therefore, we are not going to be making a journal entry. And so what you can see is for activity number 5 is there's nothing recorded in the financial statement template. And in fact, you would not go into the accounting records and create a journal entry number 5 and put nothing in it. But in order that we can follow what's going on in this example carefully, I've gone ahead and put in row number 5 and displayed it as being empty. In transaction number 6, the owner of the firm decides to take home some tires for their family. They're taking home 600 euros worth of tires, and the question is how to treat this. So one of the issues that we're addressing in this particular example is the issue of the economic entity. The sole proprietorship, the auto parts business, is not the same as the owner or his family, and therefore we want to put a boundary between the two of them. So he's taking the tires home. We now need to say the tires are no longer part of the auto parts business. So we're going to remove 600 euros worth of inventory. And then the question is, what else changed in the firm? And since this is a transaction involving the owner, that taking the tires home is not considered to be a sale, because transactions with the owner do not have any sort of gain or loss or profit associated with them. Therefore, we're going to say that his taking the tires home is a return of some of his initial $80,000 in investment. And therefore, if we go and look at the financial statement template, we will see that inventory declined by 600 on one side, on the asset side, and on the liabilities and equity side, paid in capital decreased also by 600. Okay, activity number 7. You now decide to go through some of the inventory that arrives, and you first go through the first shipment of inventory which occurred in activity number 2. When you do that, you discover that 300 euros worth of that inventory had been damaged in shipment, and so you return it for a cash refund. So we will be having an inflow of 300 euros in cash and an outflow of 300 euros worth of inventory. In activity number 8, you continue to examine your inventory. This time you're looking at the second shipment, the one you purchased in activity number 3, and you discover that they've sent you some inventory that is the incorrect size. So you want to send it back and replace it with the correct size. So that's 800 euros worth of inventory shipped out and replaced with 800 of a different size inventory. So the question is what to do here. The book says what you should do is record no entry because there was no cash movement and there's no direct or measurable impact on current business transactions because you simply swap sizes. It was of the same value. To be truthful, what people will have done is recorded the exact nature of the inventory that was received, and they would have to punch that amount out and record in the new amount to reflect the fact that it was a different size of inventory that you now have. But I agree, net, what's going to happen is there's no change in value of the inventory, and so your overall financial condition is unchanged. And now we're going to move on to activity number 9. You continue to look through that second shipment of inventory that you received, and this time you discovered some of the inventory is just of unacceptable quality. So you're going to return 500 euros worth of inventory. In this case, you're not going to get cash back. What the vendor decides to do, because they had extended credit to you and you never paid for it, is they're going to reduce the amount you owe them. So what we're going to have here is our first instance of a reversing entry. So we had an account payable created in conjunction with activity number 3, that second purchase of inventory, and now we're going to reduce or reverse or liquidate the amount of the account payable when we send the inventory back. So what you can see now is, in association with activity number 9, a decline of 500 in inventory, a decline in an asset, and an offsetting 500 euro decline in accounts payable, which is on the other side of the balance sheet equation because it is a liability. In activity number 10, you're going to pay 2,000 euros to pay off part of the promissory note that you provided back when you purchased the equipment. So we're now going to have a second instance of a reversing entry. The note payable was created a liability of 10,000 euros. Now you're going to pay part of it down, reversing or liquidating part of that note payable. So we'll see a reduction in cash of 2,000 euros as an asset dropping and an offsetting $2,000 reduction in notes payable, which is a liability. In activity number 11, you use some of your own cash savings of $5,000 to acquire a piece of equipment. You then give this piece of equipment to your business. So here you are again, the owner, engaging in a transaction with the firm. So we're again going to think about this concept of the economic entity of the firm, where there's a boundary between you and your business. So what is entering inside of the business is that 5,000 euros of equipment. And since you are the owner who's giving the equipment to the company, there's not going to be any gain or loss or anything like that based on this contribution. So we're going to consider this $5,000 contribution to the business as an increasing your investment, and therefore equipment will go up by 5,000 euros on the asset side, and paid in capital, which is an equity account, will go up by $5,000 on the other side of the balance sheet equation. And now in activity number 12, we're going to pay $3,000 on the open account. What that means is we're paying off part of the $8,000 of inventory that we purchased in activity number 3. So this is another example of a reversing entry. In activity 13, 2 of our transmission manufacturers who are suppliers to our business have announced a 7% increase in the prices they're going to charge us in 60 days. So what they're doing is announcing the fact that on future orders, there will be a price change. So we're not going to record a journal entry. And the reason for that is there's no cash movement and there's no direct or measurable impact on our current business transactions. The price increase is not affecting any orders that we presently have with the supplier. And now in activity 14, you're going to use your own personal cash savings of 1,000 euros to acquire a new TV set for your family. This is another example of thinking about the economic entity principle and the separation between the owners of the firm and the firm itself. So the owner of the firm is taking his personal money to buy an asset for the personal use of his family. So there's nothing about this particular transaction that involves the business. Hence, there will be no transaction recorded in the books of the auto parts business. And now to go to the last activity, activity 15. It's written in a bit of a complicated fashion, but when you really sift through it, what it ends up saying is that the business is engaging in an asset swap with another business, and so it is going to give up some equipment in exchange for some cash, and that the cash they're being paid is a fair value equal to the value of the equipment on the books. So what this is saying is there's no gain or loss in this transaction, and therefore we have just a plain vanilla asset swap. Equipment is leaving, hence a drop of 2,500 euros, and cash of 2,500 is being paid to us. The final step that we'll engage in is the computing of the closing balances. In order to do this, we're going to start at the top of each column, start with the opening balance, which in each case here will be 0, and then add every number that we find in the yellow section, the transaction section below that. We will be adding any black number and subtracting any red number. So in the case of the account payable, we start with none. We created accounts payable, it went up to 8,000. We then had gotten a credit and reduced the balance by $500, and then we paid off $300. So our ending balance will end up being $4,500 in the accounts payable. And we're going to do this for each account. So now it's now left at the bottom, highlighted in the red box surrounding the light blue closing balances, are the ending balances we would use to prepare a balance sheet. This homework problem does in fact ask you to prepare a balance sheet. I'm not going to go through that in this video. If you'd like to have an example of how to work through taking the closing balances from the bottom of a financial statement template and converting it into a classified balance sheet, I recommend you listen to the homework rant for Chapter 1, Problem 31. Thank you very much for listening.